Jeff, let us transition from these series of articles to talking about the reflation that's taking place right now since, I don't know, let's say since May. And it's quite a funny reflation in the sense that starting in May, not too long after it, we had the summer slowdown. So that's sort of how can that be when we have a reflation and a summer slowdown? But I suppose that will be the message that you'll be telling us from your article here. Reaching half a year, what's the complete reflation situation, posted February 3rd at Alhambra Partners. Jeff, this is not our first reflation. This will be our fourth one. Tell me if I've got them right. It was green shoots, global growth, globally synchronized growth. What's our bumper sticker for this one? What do you think?
I think it'll have to be scare quotes, right? I know I use scare quotes about too many things, but is this reflation? I mean, it's kind of in the right direction, but when we compare it to the other reflations, especially in the financial and monetary indications that we use most often, it comes up short in almost every one of those. And so, is it even really reflation-ish? I don't even know what kind of a bumper sticker slogan it would be. I think if we were to put a name on it, it would be, hey, it's not COVID.
Yeah, vaccine secured, something like that.
Yeah.
And Jeff, what you just said is something very important. It's getting weaker each time. Each reflation is getting weaker. Green shoots was pretty impressive in a sense. I mean, it seemed like
the reflation number one actually looked like a recovery in a lot of aspects. There were some things that gave you pause and said that something's not right here, but there was momentum. There was, bond market yields there was a lot of things that were going on that made you say, for people who thought that was recovery, you could understand why they associated with it.
And that was, I'm going to call that 2009 to 2010. That was green shoots. Then we had global growth after the European sovereign debt crisis from 2013 to halfway through 2014. And that one was pretty good. I guess it was, what was it? It was kind of helped along because Bernanke said, we're going to have QE forever. You know what? Everything looks good. We're not going to have QE. We're going to start drawing back. So that was kind of a okay one. It was not as strong as green shoots. And then I thought the globalized synchronized growth, it was ironic because while the reflation had some moments that were strong, some impressive points, but mostly it was weaker. What was the strongest? The publicity campaign. That was the strongest.
Yeah, the term globally synchronized growth itself was supposed to convey that meaning, right? It was supposed to say, oh, forget about those other two. This is the one we're putting all our chips on. And in fact, the way the official world responded, not just in the US, I'm not talking about just Janet Yellen or Jay Powell, Mario Draghi, Haruki Kuroda, all of these people they really bought into the globally synchronized growth hype. Now, whether they actually believed it or they were just trying to sell it to the public, that's sort of a debate. In some sense, it doesn't even matter because that's what they were doing. They were saying, look, time's running out on this QE stuff. It's 2017 already, 9 years after the crisis. We kind of got to sell this recovery stuff or people are going to start losing faith.
There's some desperation, desperation in the air of that. I'm not going to call it propaganda, but the marketing campaign. That was my sense.
To me, that's why it got to be so hysterical, because when you stopped and looked at it, there was absolutely very, very little, the least amount of evidence for anything like an inflationary acceleration at that time compared to the other times. And so it was so overhyped, and everybody really, the mainstream in particular, really wanted to jump on board. And I think a lot of it had to do with the desperation that, look, it's 2017 and we still haven't recovered from the Great Recession. Therefore, what are we going to do? What comes after this? And of course, what actually comes after this, where we're going here, is that if it's only ever reflation, that means it's not recovery. And so what's going to follow reflation is another euro-dollar, global dollar shortage. These things go together, one and the other. So if we're stuck in weakening reflations, what we expect is not recovery, not inflation.
If we're going to continue with our alliteration, you would call it ratcheting, as you do in your writing. You have one analogy, the noose, and then tightening, and the other one is the ratcheting down. But we'll go with the R. Now, Jeff, that's just your opinion, but you've got some metrics here that you call on, and you say we can't measure the euro dollar itself like dark matter. We have to measure the euro dollar's impact on other things. So what are some of the measures that you turn to see if this reflation is good? I know one that Janet Yellen and Mr. J. Powell will come, if they're watching this show, in the comments section, they'll say DXY. Jeff, explain that.
Well, DXY is the dollar index, and that's one, I think maybe there's misconception about what we do too, is that we place too much emphasis on the dollar's exchange value. It's really just one indication in a big survey, or broad survey of a lot of indications that suggest what must be going on into the shadow money system that we can't directly observe. And so if we see the dollar going up or the dollar going down, that's not an end-all be-all of what's happening. That's just, okay, is that consistent with everything else? And if we see the dollar going down, we would expect, okay, Treasury yields would be rising significantly, the yield curve steepening, Eurodollar futures in the longer end selling off. All these types of corroborating instances that would tell us that in general, the entire Eurodollar system is acting reflationary, hopefully as the next step as the first step toward recovery. So if things start to become reflationary, gain enough momentum, gain enough substance, and they're able to be sustained, then reflation becomes recovery. And we would expect to see that in falling dollar, rising yields, yield curve shape, all these other indications. So if we start with the dollar, we can't end with the dollar.
No.
And obviously, if we see the dollar going up, that's a bad sign, not a good sign.
The DXY is approaching the lows of reflation number 3, globally synchronized growth, meaning that would be the representative of the easy policy. So that suggests a reasonable reflation on par with globally synchronized growth, which was okay. But the more broadly weighted dollar, not as enthusiastic. Right, Jeff?
Not at all. Not even close.
Yeah.
Yeah. And so when you account for the euro, as we've talked about before, the euro and the British pound in particular, which I believe their moves have been amplified by Brexit. The fact that Brexit doesn't look like it's going to be the nightmare that it's been told since the vote. So there's a lot of positivity around the euro and the pound that doesn't have anything to do with really what's going on in the global euro-dollar system. And so if we remove at least some of the influence or all of the influence of the euro, you look at the dollar exchange value, and it isn't really moved all that much since its March extreme. It has moved. It is lower, but it isn't, it's not forcefully or unambiguously reflationary lower. Treasury. It certainly isn't crashing, which is the narrative you get from the DXY people, that, oh my God, the dollar's crashing. It's nothing of the sort.
Yeah, the DXY looks crashy. The broader one, no. But what about Treasury yields, Jeff? Are Treasury real yields blowing up, inflating as the bond rout has begun and the US Treasury Security in a conflagration of an inflationary fire, in the reflation that's about to take off, Jeff? Is that what we're seeing right now? Admit it, Jeff. That's what's happening.
Well, look, the 10-year U.S. Treasury, the benchmark nominal yield, hit its closing low on August 4th of last year, which means this week being February 4th, it's been 6 months. And over those 6 months, long-end Treasury yields have been rising. So they have been at least moving in the right direction. And sometimes they're described as sort of, oh my God, this is an inflationary nightmare. It's starting to happen. But if we look at, 6 months is certainly a sufficient long enough period where we can start to make some decent determinations about the conviction behind that kind of an idea, or whether or not the market actually believes in this kind of thing too. And the purpose in the context of reflation is that, well, let's compare this 6 month period with Reflation 3 and Reflation 2 and Reflation 1 if we really wanted to. So how does this initial 6 months compare? And we look at these various parameters, starting with the 10-year Treasury yield. What we find is, yes, interest rates have gone up for 6 months straight, but in no way like even Reflation 3 or not even the same ballpark as Reflation 2. So if there's any kind of inflation or positive signal coming out of bond yields, I'm not sure what it is, other than what the Treasury market and the rising yields say is that, well, it's not getting worse. I think that's really what we're at. We're not even into reflation. It's the market with these nominal yields rising, basically reflecting on, well, it's not 2020 anymore, and maybe 2021 will go better. But the probability of 2021 being a whole lot better than 2020 can't be very much, or we'd see more out of the Treasury market in rising yields than we have.
Inflation, Treasury inflation protected securities. They're related to what we were just discussing, the Treasury securities. But we did discuss in an episode or two ago that we see inflation rising at a faster rate than the nominal yield, and therefore that means real yields were falling. I think, did you see the latest numbers, Jeff? Not so reassuring. But let's talk about the inflation signal. Is it still what you thought before? Is it still being driven by the consumer prices index and oil and fuel?
Yeah, and I think, inflation expectations, or specifically the break-evens and tips, which are the difference between the real yield and a particular maturity, say the 5-year or the 10-year, and the nominal Treasury yield at the same maturity. The inflation break-even, or the expected rate that the Treasury market expects the government to get paid based on what they think the CPI will average out over that period, the break-evens have been rising. A lot of people that are pointing to inflation are saying, well, look, break-evens are rising and even rising rapidly. And that's true too. But does that, and not only that, break-evens are at multi-year highs, which is a term that always gets thrown around in these periods because it sounds really impressive, right? The highest since early 2019. Well, when you think back to 2019, you think it wasn't really a great time.
That's sad. That's so disingenuous by the financial media that does that. I hope that's only being done by politicians and by perhaps people talking their book. But if the media does that, it's
somewhat irresponsible.
A failure. Yeah, it's a failure of your duty as a person in the media, the highest in years. We're in a depression. All right, go on, Jeff. I'm sorry.
No, and so, if we look, I think, inflation break-evens in particular have been one of the things that the people who are advocating inflation have been hanging their hats on. And so if we compare this reflationist period, the last 6 months and before, to Reflation 3 and Reflation 2, what we find is that no different. In fact, the long-run 5-year forward inflation rate is basically on the same exact track as Reflation 3, which, as we just discussed, was the weakest of the bunch. So yes, inflation expectations are rising, but we would expect inflation expectations to rise off a severe trough. That doesn't really tell us much. And the fact that it's not really going better than Reflation 3, and by the way, Reflation 3 did not end up in an inflationary fire, just to reiterate, that's not a good sign for the inflation case either.
Let me just underline that point again. I didn't think of this earlier. This shock, the reflation number 4 that we're experiencing should be stronger. It should not be as weak, right? Because we came out of a deep hole. So just like the rubber band, just like Mr. Friedman's plucking model, it should be really
symmetrical. Symmetrical. That was the concept that symmetry. If the farther you go down, the quicker and faster you come back up. That's really the idea. It shouldn't be weaker every time. It should be stronger.
It shouldn't be weaker every time, and it shouldn't be weaker or about equal to number 3 if the dive of Eurodollar event number 4 was deeper maybe even than 2008 in certain circumstances.
You bring that up too. Compared to reflation number 3 in TIPS market, it really didn't get too other than the extreme points in March. Inflation expectations were at their lows about the same as they were in 2015, 2016. Other than that really short crisis space, it's not like the inflation expectations have had that much farther to come back from over the last 6 months or so. In fact, that's why following along reflation number 3 almost perfectly is actually a negative indication, not a positive indication.
It's not reassuring.
Right, exactly.
Swaps. That's another one of your key arrows that you pull out of your Eurodollar quiver when you want to understand where the system is. They're short-term swaps. and long-term swaps. And you explained it to me once before that the short-term ones don't take up a lot of space on the bank's balance sheet, right? You don't have to put a lot at risk for a 1-year swap, but a 30-year swap, a 10-year swap, that's serious. You're taking up serious space on your, it's not serious, you're taking up space on your balance sheet.
More space. It's less efficient. Yes.
And therefore, if those are indicative of kind of the risk appetite of the institutions that create money in our modern global economy. And therefore, those are the ones that, I guess they would be the last ones that we typically see in a reflation to turn around, the ones that we're like, yeah, all right, we're heading in a good direction. We're going to take on more risk with these longer term swaps. Jeff, do I have that right? And what do we see in swaps?
Yeah, you have the basics right, and I think it's obviously much more nuanced and complex than that. But overall, that's pretty much.
I think, I'm happy with that.
No, I think as far as a brief explanation, that works perfectly. It's really about balance sheet constraints and efficiency and how banks manage their overall balance sheets. And they're a reflection of capacities and efficiencies in those certain dynamics. And so what we'd expect to see is swap spreads decompress as banks take on more risk and more confident that they have more balance sheet space over the long term. And so we do see that. We see swap spreads decompress in reflationary periods. But the swap spreads, especially at the 10-year and the 5-year maturity, they've been decompressing more at the 30, but that's because they were at very extreme low levels. And they're still negative by about 25 basis points. But at the 10-year maturity, which is an important benchmark, it really haven't moved much at all. There really hasn't been much of a decompression outside of maybe back in volatility in April and then over the summer. So over the last 6 months or so, while everything else may be somewhat reflation-y, swap spreads have been pretty much pegged. The 10-year spread has been pegged less than 5 basis points, which is not a whole lot at all.
And if you turn to this article, everyone in the audience, it's called Reaching Half a Year, What's the Complete Reflation Situation? You'll see a great graph here going back all the way to 2006. You'll see the 10 and 30-year swaps. And the 10 is very interesting. It has followed that weaker reflation pattern. The 31, I guess, that felt a little bit better about global growth, number 2. It came back stronger there. But let's talk about reflation number 3. It looks like the 10-year swap got up to 10-ish, almost. And right now we're stuck at 0. And like you said, it seems to be kind of just...
Go back to reflation number 2, where the 10-year spread was up closer to 15, 20 basis points. Mm-hmm. And so you're exact. It's the ratcheting effect where banks are saying, we're not really taking we're not carving out a lot of balance sheet space to take on these risks or manage these risks as from other risks that we're taking on.
You also have a couple more graphs here, with one being the yield spread between the 10-year and 2-year US Treasury Security, and another one showing the 10-year US Treasury Security yield, and you're comparing to Reflation 2 and Reflation 3. In both cases, Jeff, is there any oomph?
Well, the yield curve shape, obviously that's something that we should pay attention to, because the yield curve, we would see nominal yields rise, but we would also see the yield curve steepen. And that's exactly what we've seen. We've seen the 10-year yield rise over the last 6 months, and we've seen the yield curve steepen at various points along the curve, including the 2-year, 10-year, which is the one most of the public pays attention to at certain times. But yet, when we classify them or compare them to in context, what we see is they not only has the 10-year yields not increased all that much, the yield curve has steepened, and it's the steepest it's been in years, but it really hasn't steepened all that much at all. And the reason it's the steepest in years is because we went through that period, as we just discussed before, 2018 and 2019, where the yield curve actually collapsed. So we haven't really come back from a collapse at all, and certainly not in a way that would make us think that this is even modest reflation. As you keep pointing out, this is the weakest of the bunch. And so we look at all these yield curve dynamics, that's what the yield curve is saying, is that, look, this is the weakest of the bunch. We've had a huge downturn, and then we're not even coming back as quickly as we did back in 2016 and 2017 when we were coming off barely a near recession, and the economy was at least moving forward at a relatively decent rate, at least relatively decent compared to the post-crisis period. So there are all sorts of these mechanics, and the big one, I think, is the TIPS real yield, which isn't even reflationary at all. If we look at TIPS real yields, they keep coming down toward record lows, and setting them at some maturities, which says that, okay, yeah, oil prices are going up, and that might be driving the break-evens, but economic growth conditions, it's not happening at all. And if we don't have any sort of real economic growth, how are we going to get any sort of acceleration, inflation, and recovery? And so when we look at all these things together, it goes back to what we said in the first segment about what's going on at the short end in the bills, risk perceptions. When we look at the rest of the bond market, the rest of the treasury market and money curves, and what they tell us is that, yeah, there's a whole lot out there that is less than desirable, which is unusual given, first of all, what the common perception is about what's going on right now, but also unusual in fact that we suffered such a huge setback last year. Why aren't we coming back, in unambiguous fashion?
Jeff, we've gone over a number of measures. Are there any measures that we didn't go over that you wanted to raise right now? Perhaps GameStop, is that an indicator of situation?
I think
GameStop,
GameStop is the stock market in general is an indicator of just how screwed up things are. Because here we have today, for example, today's Friday, February 5th. We had the payroll report come out, which was really bad. Second straight really bad payroll report. We've got a 10 million jobs deficit, including 2 million jobs that didn't happen. So we're really 12 million jobs short of where we should be. Yet the stock market's at record high. We've got all sorts of screwy stuff going on with GameStop and short squeezes and things like that. And it's becoming clear to most people that these things are totally detached. What's stocks, the reality of this current situation. And of course, people who are, proponents of stocks and the stock viewer are saying, well, no, stocks are just looking ahead down the road and saying, as we started off at, that none of this stuff will matter. None of this unemployment, none of this COVID, none of the pandemic. The vaccines will fix the pandemic. The stimulus will fix the economy. And then if we look far enough down the road, things will be really happy and good again. That's really what the stock market is saying. And people trading in GameStop, what they're really saying is that, yeah, we can look past the misery of today because tomorrow will be really good. What we're saying is when we look at the bond market, which has been proven correct more often than not, the bond market is saying it's not that easy. You can't just ignore these big problems and think that they'll all just be perfectly fine over the months ahead. And oh, by the way, if you're counting on the federal government and the Federal Reserve as the catalyst to make sure everything goes right, you're going to be very, very disappointed.
I'd like to suggest that the stock market is being presented to us in a way that doesn't send an accurate message. And what I'm trying to say is that the S&P 500 is market capitalization weighted, meaning our 6, 7, 8 top stocks are gaining in value because perhaps people want to put money in dollar-generating monopolies. That makes sense. But if you look at a equally weighted, geometrically weighted, I think Value Line does this, and I haven't done this for over a month, but the last time I looked at the Value Line geometrically weighted index, which is 1,600 stocks in the US and in Canada, and what it reflects is kind of the median publicly traded North American company. And what did it show? It was well below the 2018 highs that were achieved, I think if it was in January. That seems to be like the stock market, the real publicly traded company situation, is that they're struggling and have been for years, as opposed to monopolies, which is what we see in the S&P 500.
And that's, going back to what we just talked about before with the difference between recession and depression, why depressions aren't short-term shocks, is that a lot of the damage that gets done is hidden. You don't see it because it's the small mom and pop shops that hurt. Google isn't gonna go out of business. Google isn't gonna be shut out from credit markets. But a medium-sized business and a medium-sized industrial business, for example, they're going to have all sorts of trouble maintaining both their cost structure as well as their access to credit. They don't have a Federal Reserve buying bonds and supposedly supporting the market. Yeah, I know there was the mainstream bailout lending program, all that stuff. which really didn't, I mean, that didn't work at all. So what, and again, why are these things longer term in nature? Is because a lot of the damage that does take place, you just don't see it. It's hidden. It doesn't show up in the mainstream indexes, which are skewed toward the parts of the system that do very well, regardless of the economic condition. You know, Google and Apple, yeah, they might take a bit of a setback last year, but those companies are going to survive. They're going to thrive no matter what. It's the rest of the system and how much of this rest of the system that has suffered material damage that that's what we're talking about. And those are the things that the bond market can't ignore, because the bond market is tied closer to the actual system. I forget who it was that always used the term with stocks, calling it the casino, because that's really what happens when stock prices start to diverge from any kind of fundamentals. And GameStop is a perfect example. It really is a casino. It's just a mechanism to transfer paper wealth from one perception to another, as Gordon Gekko said famously in the movie Wall Street. That's really all it is. It's not a signal. It's not an in-depth fundamental analysis. It's not discounting future perceptions. It's just simply people trying to gain each other.
Rudy Havenstein, the part-time central banker for Weimar Germany and full-time social media sensation, is the one that says casino and calls it a casino all the time. Wonderful stuff. Jeff, I loved it. Next week, dear audience, we'll be back to 3 full episodes, 3 full parts per episode. Jeff, I'll talk to you next week, and congratulations on a fantastic Buffalo Bills season. You guys did awesome. It's not your fault. Patrick Mahomes, wonderful. Don't be upset, Jeff. You guys did awesome.
It was a good season, but it wasn't enough, and we're gonna have to come back harder and take it next year.